how to calculate your true net payout. That is today's question on the Transition to RIA question and answer series. It is episode number 72. Hi, I'm Brad Wales with Transition to RIA, where I help you understand everything there is to know about why and how to transition to the RIA model. If you're not already there, if you head on over to transitiontoria.com, you can find all of the resources I make available from this entire series in video format, podcast format. I have articles, I have white papers, all kinds of things to help you better understand the RIA model. And again, for you podcast fans, if you are watching this in video format and would prefer podcasts, you can search for the Transition to RIA podcast on all major podcasting platforms. And you can follow along this series in that format as well. So like I said, on today's episode, we're going to be talking about, your true payout of kind of wherever you are currently and how that might compare to the RIA model. So a common part of the conversation I have with advisors that are considering, hey, here's where I am now, whatever that might be. It might be a W-2 broker dealer, it might be an independent contractor, broker dealer, and they're saying, hey, should I be moving to this RIA model? How does it work? What would that look like for my practice? And so a typical part of that conversation is understanding the economics of it, which is an important part of it. So, hey, what are my economics currently? What would my economics look like in that RIA model? And there's different flavors of it, which I'll get into. But how do those compare? And so the first part of that is typically to properly identify what are your economics currently? And so typically going through that conversation, I will ask an advisor team or whoever I'm talking to, I would say, okay, well, what is your payout now? And then the responses I get back is kind of what prompted me to do this entire episode, because more often than not, my experience is that advisors not fully appreciating what their true payout is, and they're going off of just kind of how their firm is positioned and to properly compare what your economics are currently to where it would be in the RIA model. You need to add up what in this case I'm just framing as your true payout is to fully understand it. So what I mean by that, just to give you two examples, if you're at a wirehouse firm now or a W-2 model type firm now, and I ask you, what is your payout? And the sole answer you provide is what the grid says, okay, your production and at your size, you're maybe a 42% payout or whatever the case is. And then that's the only thing you say. But the reality is the compensation plans at these firms usually run 20 plus pages. It's not just that little table, just that little chart, as it arguably maybe should be. So if all you do is quote that chart, and then you look past all the different ways those 20 pages work to whittle that number down, you're not fully considering your true payout. So by whittling down, there could be different firms have different ways they kind of monkey with this. It could be, you don't receive a payout on the first $4,000 in production you do each month, or you don't receive a payout on certain size accounts, so you receive a lower payout, or by the way, if you don't make certain banking referrals to our banking channel, you're penalized a point or two. And so the reality is, when you want to talk about your true payout in that W-2 model, you can't just say, oh, what does the little grid say? It's what does the grid say? But realistically, after we put all these gimmicks in, what is the actual payout that essentially flows to me as the advisor? So at a high level, that's the first thing that needs to be considered with that W-2 advisor arrangement. And then in the independent broker dealer model, and this is where I definitely see this sort of thing all the time. I'll ask an advisor in such a channel and say, oh, what is your payout? And then the answer will be, this seemingly generous number. It might be, it's 92% payout. And then I usually don't say anything. I just want to kind of see how that answer evolves. And that's usually the extent of the answer. And then we'll maybe be talking about what they get for the payout or those sorts of things. And then if it doesn't come up, which it usually doesn't, it's prompted by me. I say, well, are you also paying perhaps, and they call them different things. Each firm calls these different things. Are you paying some sort of, platform fee or advisory fee whatever the case used, and that's usually expressed in basis points. And the answer that comes back is, yeah, that is in addition as well. So it might be a 92% payout, but then there's a 20 basis point platform fee, and then sometimes the quick rebuttal is, yeah, but the client pays that. And so that's what I want to dive into here is well, how does that really impact actually your payout? Don't just think of it as what that little grid says. The devil's always in the details. And again, in that independent broker-dealer space, you typically always have a so-called quote-unquote payout joined by the advisory asset, some sort of platform fee, advisory fee, whatever they want to call it. And it's usually, again, expressed in basis points that's in addition. So what I suggest you do instead is say, when you want to try to figure out your true payout, and particularly that latter example with the independent broker-dealer advisor, is to say, okay, what is the total that the client is paying? So how much is the client paying total? How much of that flows to me? So as an example, let's say you are in that independent broker-dealer space, and we're going to use just very simple numbers here, and your fee for your services that you provide is 1%. And then of that 1%, you get a 90% quote-unquote payout. That is what you retain. So you think, oh, I keep 90 cents on the dollar. That's being very generous of my firm. And I get this high payout that I run my practice with. However, that same firm might also have a 20 basis points platform fee that, again, is in addition to that. And of course, that none of that is received by you. So in total, again, consider what the client is paying in total. You are charging 100 basis points. The platform fee is 20 basis points. So total the client's paying 1.2%. Now, at the end of the day, the client doesn't care who is getting what behind the scenes. The client just says, how much am I paying in total, and what value and services do I receive in return for that? So in this case, even if you want to say, oh, but the client pays that, okay, correct. So the client is paying 1.2% in this example here. However, you as the advisor, again, we're using simple numbers here in this example, you are receiving a 90% payout on your part of the fee only. So you're receiving 90 cents on the dollar for the 1% part of the fee you charge. However, so you're getting 90 cents. 90 cents is going to you. Again, gross, you still have local expenses to cover, is going to you, but the client's paying 1.2. So when you run that math, 90 cents on $1.20, to use simple terminology, is a 75% payout, not a 90% payout. If you consider what does the client pay and how much of that actually flows to you as the advisor, that 90% all of a sudden now is a 75% payout. That's not nearly as generous, nearly as lucrative as it seems. So you can understand why a lot of firms position it this way, particularly because they want to be compared, or they know they will be compared against other broker dealers, and say, oh, what's the payout at this firm and what's the payout at this firm? So they want to be able to say that 90%, 92% or whatever. But that's irrelevant if you're not also going to factor in these additional, often platform fees that are being charged in addition to it. So you have to consider the total fee the client's paying, how much of that actually flows to you. Now, the one kind of caveat I would throw in the example I just gave, typically, that is a typical example that does not involve any sort of managed money solution. So that is where the advisor themselves is managing the assets in their own methodology, their own models, or whatever the case may be. If you want to use a managed solution, then that is typically in addition, or just a larger quote-unquote platform fee to access an SMA manager or professionally managed portfolios, whatever the case may be. And that should have an additional cost, because there is that additional service being provided to the client. And even then, which I'll get into, is you compare that to the RA model, you have to add up those. That's typically in basis points as well. What are those basis points? How much is the client paying? How much of that actually eventually flows down to me? And you can say, yeah, but the client is paying it. But as I'll demonstrate in a second, there's ways to try to manage that perhaps in the RIA space. So how much in total does the client pay? How much in total actually comes into my pocket as the advisor? I encourage you to do that exercise and figure out kind of what that math is for you as well. So the question is, okay, if you do that, and you do that genuinely and find out your true payout number, then okay, how does that compare to in the RA space? So there's a couple different pathways into the RA space. And obviously this entire series of episodes is based on answering those pathways and the ways you solve for things and whatnot. So so I've answered this in different kind of episodes, but at a high level, a couple different ways into the pathway. So let's say you start your own RIA. In that situation, 100% of the fee that you charge the client for your services, your advisor part of it, 100% comes to you. Not 90%, not 40%, 100% comes to you. Now, to be fair, I'll dive back into this. You do, right, then have expenses that you have to cover for running the firm. So it's not 100 cents that goes into your pocket on the bottom line at the end of the day for net income, but 100% of the fee comes to you. And you could say, okay, well, what about that 20 basis points or the SMA manager, or whatever the case is? So typically, as you're considering, hey, what am I kind of being charged now, or how much am I receiving now, and how does that look in the RA space? To say, back to my example, if your client currently is paying 1.2%, because that's your fee and this so-called platform fee, and again, for simplicity, we won't bring in a managed money solution into that just yet. There's really no reason you can't continue to charge your client 1.2% in the RA space, because as of the moment, your client is paying 1.2%. You are providing value and services in return for that 1.2%. And because they're remaining as your client, they appear satisfied with the value they are receiving for that fee. So if you move into the RIA space, all of a sudden you could maintain that 1.2% fee. 100% of that goes to you. And then again, from there, you do have expenses that you need to whittle away from that. But that top line payout, if you will, goes to you. And so that's why the term payout is not even applicable when you have your own RIA, because while the custodian might help facilitate the actual deductions of the fees from clients' accounts and remit it to you, it does not go through their P&L. Does not go through any sort of payout grid. It's just 100% yours. It's just remitted to you, and then you cover your costs and you run your own P&L. So if you start your own RIA, think of the top line payout is 100% goes to you. You then cover your expenses from there. The other kind of main pathway you might go into the RIA model is to join an existing RIA. So in that case, those providers, and I've done all kinds of episodes on this, have bundled up a lot of the necessary components of running an advisory practice, and they provide them for you, as opposed to when you start your own RIA, you build all those pieces out yourself. And so in return for when you join an RIA, for them having built those pieces out for you, they, of course, have to retain something from your fee to cover their costs and to generate profit for themselves. And so in some ways, you could refer to that as a payout. And while some firms do express it that way, where it's a percent of the fee that comes in, they say, hey, we do take 90% or 92% or 90, whatever the case is. And here's what we provide you in return. Some firms do it that way, but I would say the majority of firms in the RIA space do the inverse, where they say, hey, if you join our RIA, here is everything we are going to provide you to help you run your practice, whether it's compliance support, technology support, marketing support, E&O coverage, whatever the case is. Here's everything we're going to provide you, and we are going to charge you. Again, they kind of take almost an inverse of a payout scenario, where what's perhaps expressed in basis points or percent of your revenue, where they might say, hey, for 20 basis points, here's everything we provide you. That by the way, if you were to start your own RIA, you have to build out these individual pieces on your own. So we've bundled this up, and we charge you 20 basis points, or we charge you 20% of your fee that comes in for those services. And personally, I think this is how all firms should do it. Basically, it's the inverse of a payout, which says, how much am I, the advisor, paying for the services that I'm receiving in return? And that's an easier way for you as an advisor to square up. Hey, is the value I'm receiving commensurate with the fee that I'm paying for it? And so whether you want to call it a payout or do the inverse, the math still comes out the same. I think just the optics of the inverse are easier to understand. So or to appreciate for what that cost is. So take that W-2 advisor. We're going to use simple numbers here. Let's say it's $1 million, or advisor is $1 million in fees and commission revenues per year. And for simple numbers, we're going to say you're in the 40% payout. grid. And let's, for simplicity, exclude what I said at the top of this episode of all the different gimmicks that absolutely exist that would absolutely whittle that 40% down to something smaller. But for simplicity, we're going to assume it's somehow magically 40%. So basically that means if you're that W-2 advisor and $1 million in fees and commissions comes in, your firm is paying you out 40%, so $400,000. Always think of the inverse of that. So that also means your firm is retaining 60%, or in this case, $600,000. And so the question is, are you getting good value for that? In this case, $600,000 you are paying for your firm, or you're paying your firm for what they are providing you in return. That is how you want to consider a payout, not just what is your true payout, but what is the inverse? So how much am I paying my firm, and what are they providing me in return? And out of fairness, firms are providing you things, particularly if you're in a W-2 model. They are typically providing you with an office, maybe some support team members, maybe benefits. They're providing you technology, all those sorts of things. And there are hard costs associated with providing you that they deserve to be able to cover those costs. And again, they are a for-profit company, so they deserve to make a profit. The question is it reasonable for what you receive in return for what you're paying? And the larger you get as a practice, the more painful that math becomes when you start, for some advisors, they are paying essentially millions of dollars to their firm via the inverse of the payout. And you have to question, am I getting millions of dollars of office space, millions of dollars of technology, millions of dollars of compliance support? And that's where the math becomes very inconvenient for a lot of broker dealers. But it's just something to think about is, okay, the inverse of it. So again, I kind of went off track there. If you're joining an existing RIA, you want to look at how they price it out. Some do it in the payout, but a lot of them do it as that inverse, and that just kind of saves you from having to do the math of what the inverse is and how do I pay for it. And again, I don't want to discount the fact that in the RIA space, I don't want to sit here and say, oh, you get 100% of your fees. That is factually correct, but again, you do have expenses that you then cover, because unlike in that W-2 space, you are paying for your own office space, you're paying for your own technology, and I'll get into kind of what you can expect maybe the bottom line here in just a moment. But to be clear, from a quote unquote payout, it is 100% coming in under your own RA. And if you join in another RA, again, it's either a payout or typically some sort of the inverse of that expressed in either percent of revenue or basis points. And so the final thing, just to kind of wrap this up, is how to kind of frame this all up. So the number one thing is when you're thinking about your payout, all that ultimately matters is what goes in your pocket. So whether you have the 20-page comp plan, you're at an independent broker dealer, maybe you have a payout and you have platform fees and you have other technology fees, whatever the case is, you need to add all that up and say, how much actually goes into my pocket as the advisor? And that is what you should be thinking of it as your payout, to be able to compare essentially apples to apples when you look at different affiliation models or different routes you could go with your practice. And so in the RIA space, while it might be 100 cents on the dollar that comes in, again, if you have your own RIA that comes to you, you do have those expenses I've been mentioning. And so to give you an idea, and I did a whole episode on what kind of bottom line income you can expect to earn as a RIA, but the typical industry range is for your own RIA. And I always say, if you're reasonably sized and a reasonably run firm, so just a quick primer on that, reasonably sized, the RIA is a scale game. So if you're too small, some of the math does not work as well. So you have to be reasonably sized to have some scale in the game, and reasonably run. So because you get to control your own local expenses, if you want to have an extravagant office, that's fine. You can do that. That's going to cost you more money. That's going to reduce what flows to you on the bottom line. And so there's all kinds of expense levers you have control over to determine just how well run your firm's going to be. And I don't want to say well run. You can have extravagant office. That doesn't mean it's not well run, but it just means you do have a higher cost structure as a result of that. But your typical RIA, and this is very high level, every advisor, every team situation is different. Your typical RIA nets about in the range of 60 to 70% of top line revenue. So for every dollar that comes in fees from the client, after you cover all the expenses necessary of running your firm, again, assuming you have some size, assuming it's reasonably run, the typical RIA makes in the 60 to 70% before the owner pays themselves. So before, if you're the advisor, you're the team, and you are the ones providing the advice service for the client, and you own the firm, before you pay yourself, 60 to 70% is what typically flows to the bottom line. So effectively, that's your kind of your net payout. And so that's, as you compare that to what you might have now. And again, that's why I did this whole episode. This is what I said at the top of the show is, you want to say, hey, what would the economics kind of like be like in the RIA space? And then what are they compared to what I have now? And so the question is, what do you have now? And are you calculating it correctly? And if the only thing you say is, oh, I get 92% or I get 45% if you're W-2, you're likely not considering the whole picture. And again, that's why you have to go through the exercise of how much are you actually netting after all the gimmicks, after all the different fees, after covering whatever expenses you might have to if you're independent, and then what actually flows into your pocket at the end of the day. That's the most important thing if you want to do an apples to apples comparison. The second kind of takeaway, and I talked on this, but just to reiterate, is when you kind of sum all this up, it's not just numbers. So I don't want to imply that, oh, the RA model is necessarily superior because the number 60 to 70% is higher than maybe the 40% at the wirehouse firm, because that would be like a client coming to you and saying, well, advisor, your fee is 1%, and there's an advisor down the street that will do it for 80 basis points. So apparently I should go with that other person because they charge a lower fee. No, because fee alone is not the whole picture. You have to say, what is the value received for the fee? So as you do this exercise, if you're at a broker-dealer arrangement now, and you do the true number, again, put all the gimmicks on the side, and then again, like I talked about, take the inverse. So the inverse of your payout is what you are effectively paying to your firm for what they are providing for you. And then I just challenge you to ask yourself, are you getting good value for what you're paying? And some advisors, that might be the case, particularly based on your size or what your firm's providing. And you say, hey, yeah, every year, again, back to my $1 million producer example, if you're paying your firm $600,000, well, if you think you're getting $600,000 worth of value every year, you might be in a good arrangement. That might work for you from an economic standpoint. This is not getting into other things like flexibility and whatnot. But you have to quantify that in dollar terms and then ask yourself, is that good value for what I receive? And if it is, hey, that's fantastic. If it's not, that's where you have to start asking yourself, okay, could I replicate that same value they are providing me in office space, technology, compliance support, all those sorts of things? Could I replicate that on my own in the RIA space for less than I am paying my firm now? And if you can, and you typically can do it with even more flexibility than you have now, that savings, that delta is where the better economics of the RA model come into play, and where more can flow into your pocket at the end of the day. But again, I don't want to harp on just numbers alone. You have to say, what value am I receiving for the amount I'm paying, and then make that a true apples to apples comparison from what you have now to another affiliation model such as the RA model, and how that works. And so the final takeaway I want to point in there is just you just have to take the time to understand how the RIA model works, how these economics would look for your specific practice. And so as you consider what you have now, and you're at whether a W-2 firm or an independent broker-dealer, whatever the case is, and you hear about all this news, but all these advisors go into the RIA space, and the numbers continue to migrate that way. Well, obviously there's a reason for that. There's a reason advisors are making that change. But you need to understand what it would look like for your specific practice. So there's a lot of factors to that don't have anything to do with economics about why advisors are motivated to move to the RIA space, and those are important to understand. But when it comes to economics, it's important to take time to understand this and understand what your unique practice would look like under that RIA space. And that's something I help advisors with all the time, is to say, okay, based on your current cost structure, based on the current services being provided to you, how your vision would look for what you would want to replicate if you went into the RIA space, what would that sort of arrangement cost, and what would your economics therefore look like in the RIA space? I encourage you to run that exercise to truly know kind of what's available to you, because it never hurts to be fully informed of how, in this case, something like the RIA model works, so you can compare it to what you have now, and then you can ask yourself, is it worth making a transition from what I have now into something different? So happy to have that conversation with you. That's a typical thing I do daily almost with advisors, to say, okay, what is your current situation and what would it look like in the RIA space? Happy to have that conversation with you as well. So with that, I hope you found value on today's episode. This is the sort of thing, again, I talk to advisors about all the time, is how does it look if you were to make a move into the RIA space? Happy to have that conversation with you as well. Like I noted, if the first thing to do, though, is if you head to the website transitiontoria.com. Again, you can find all of the videos I make, the podcast, the articles, the white papers, all kinds of resources there for the taking to help you better understand the RIA model. But at the end of the day, the most effective, helpful thing to do is to reach out to me for a direct one-on-one conversation. So at the top of every page is a contact link. If you click on that, you can instantly and easily schedule a one-on-one conversation with me, and we can dive into today's topic or anything else RIA related you would like to chat about. Again, head to transitiontoria.com. And with that, I hope you found value in today's episode, and I'll see you on the next one.